Hey there, I'm Paul Rabelais. I'm an estate planning attorney and strategist for all of our clients all around Louisiana who want to make sure they get and keep their legal affairs in order and keep what they have in their family for at least the next generation or two without all the difficulties that other families face. So in this video, hope to help you really understand some of the myths around trusts and income taxation. And I guess, every time I make a video on YouTube or wherever this might wind up, for what it's worth, I always mention that, after I finished law school, I went up to Boston and earned a master's degree in tax law from Boston University's law school. So not that I remember a whole lot from back in 1991, other than it was really cold in Boston. But I do actually remember studying some of the Grantor Trust rules, which is what we'll be talking about today on this video. Okay, so here's the situation. It's happened many times. Someone comes into my office and I ask them what they want to make sure they accomplish from an estate planning perspective. They tell me what they want to accomplish. I listen very closely. I ask the right questions at the right time and listen to their answer, and so that I can ask the next right question. And then the conversation, in order to accomplish whatever it is they may be trying to accomplish, sometimes the conversation turns toward creating a trust. And so we finish the conversation. Everybody says, that sounds great. High five, client goes on their way, we get to work. And then sometimes I get a call a day or two later from the client saying, hold what you got. I'm not so sure I want to create a trust. And then they go on and say, this is no disrespect to the financial services industry. I have many friends, many professionals in that industry. They do a phenomenal job. But sometimes it comes back to me and it says, hold on, Paul. Not so sure I want to set up a trust because I went and talked to my accountant, my CPA, my financial advisor who says he is a holistic financial advisor and he is the quarterback of all things financial to me. And when I told him I was considering setting up a trust, he said, you may not want to do that. He pulled out a brochure of his company and it showed that the trust income gets taxed at 37% of all of the trust income that exceeds $12,750. And so based on what my financial advisor is telling me, I don't think I want to have a trust because 37% is a really high income tax rate. So at that point, I kind of, oh boy, here we go again. So let's get to the bottom of it so that hopefully, we all can have just at least an entry-level understanding of trusts and income tax and when trusts are taxed and when they're not. So let's jump right in. Again, no respect to those financial advisors, but it's just what the words that come back to me. All right. I would venture to say that in today's legal, tax, medical, lawsuit environment, most trusts that are created are, for income tax purposes, grantor trusts. Now you say, what the heck does that mean? So in general, what that means is when someone called a settlor, that's the person who sets up a trust. When someone sets up a trust and they transfer assets of theirs to their trust and they retain certain elements, if they retain certain elements in that trust, then the settlor, the person who set up the trust and transferred their assets to the trust, is still considered as the owner of the trust assets for income tax purposes. So again, it's called a grantor trust. where if it meets certain guidelines or requirements, the trust doesn't pay any tax. All of the trust income flows through to the settlor's personal income tax return. So really there's several different types of grantor trusts. And as you might imagine in our Internal Revenue Code, some are common and some are really, we never see them. So, but two really common types of grantor trusts are the very common revocable living trust that's designed to avoid probate. A lot of people, they don't want their survivors to have to go through the court supervised process of managing, settling an estate. So they set up their revocable living trust, and assets in a trust don't have to go through that court process. Assets in a revocable living trust, all revocable living trusts are grantor trusts, which means the trust doesn't pay any income tax. If your revocable living trust owns some rental property or an investment account, and either rental income or investment income or interest is produced, all that just gets reported to you on your personal income tax return. So there's no more or less tax paid as a result of establishing a revocable living trust. The second kind of grantor trust, which is very common, is this irrevocable income only trust. Commonly used because many people perceive the biggest threat to losing what they have is getting sick and perhaps going to a nursing home. So many people throughout Louisiana, throughout America, establish these income-only trusts so that the assets are out of their name for nursing home or Medicaid eligibility purposes. And so that trust is also a grantor trust. Again, as that trust produces income, it goes to the settlor, also called a grantor, also called a trustor, and the settlor, or the person who set up the trust, just reports that income on their personal income tax return. So, a married couple who files jointly, they can have up to, I think it's $612,000 of income in a year without getting up to that top 37% income tax rate. Yes, the trust income tax rates are burdensome, 37% when the trust income is $12,750 or greater. But many trusts set up are grantor trusts. They're not subject to the trust income tax rules. The settlor pays the income tax on the trust's income. So when you're in that ballpark and you are not sure what's going on, you may just want to ask, hey, this trust that we're talking about, is it a grantor trust? You may get some brownie points if you ask that question. So hope that helps. But many people, many kind of advisors who dabble in the trust arena, whether they're an accountant, a CPA, a financial advisor, a stockbroker, investment professional, whatever, they hear trust, they look at a quick brochure or form, they see 37% income tax rate on trust income, everybody freaks out. My only point is, let's slow down, let's explore, really what type of trust it is and how that trust income would be taxed. And it may not be what you initially think it would be. So hope that helps. I'm Paul Rabelais. Go and have a great day.